What if I were to tell you that the S&P literally came up with a framework to judge tokens and to see whether or not they're actually eligible or even investable? Let's talk about this. So they went through 4,500 tokens that are listed on a regulated exchange. Okay, here's the thing. Less than 100 had a circulating market, key point, circulating market cap, total tokens out times the price, that's the circulating market cap, greater than 500 million. Okay, 30 of them had actual protocol revenue with 2 consecutive quarters subject to a minimum threshold. But here's the thing. Only 18 of them actually came out as potentially viable, right? So think about this. What's really going on, right? Look at all these protocols that are out here. What's the point of these tokens? Why did they come out? Well, really the point of the tokens, and everyone knows this, is to sell and to enable the insiders to make profit. That's why the tokens existed. It wasn't like the token existed to pipe value back to the holders and things like this, because also these protocols really aren't generating a whole lot of revenue, right? So why does the token even need to exist then? We heard that classic phrase, so why do you need a token? Well, when you start thinking about it in more detail, how does a token make the product better? That's the question I always ask. Not why do you need a token? That's a gotcha question. How does the token make it better? How do you actually create value for the holders of the token? This is the question to answer, not why do you need one? That's the wrong question to ask, especially the day and age where I believe everything will be tokenized in the future, right? So why do you need a token? Because everything is tokens. AI takes tokens in, AI puts tokens out. It makes logical sense in the future. Every single thing will be a token in some respects, right? So, but if we think about this, let's just talk about Hyperliquid a little bit, right? Because this is one of my favorite examples of projects that I've been talking about for years now, right? Since like 2024, I've been talking about Hyperliquid, how important it is, but also how much I like the fact that they're also, Hyperliquid is also piping the value back to the holders and stuff, right? So if you look in this chart right here, it says revenue annualized, holders revenue annualized. Look at this, they're both the same. So what is this actually talking about? So if we had our revenue that the platform was making, okay, and that's just going to the team or treasurer or whatever, that's not actually going to the token or the holders. So in this case, the chart was actually showing how everything is going back to the holders. Everything is going back to the token. So if you're someone who's holding a token, it's not like that value piped in props the price up significantly, but what it does is it creates psychology in people's mind that tells them, let's think about this. One token I'm holding, the team says, hey, we're going to pipe all the revenue we get back to the token. What does that do in the minds of the people? The other one says, you know what? We're going to keep all the money for ourselves. Like look at Aave as a great example. Going to keep all the money until they change some things. Let's just keep everything for ourselves. Keep all the money. People complain about that. Why hold the token? What value is it of Aave? What's the point of holding that shitcoin? Pardon my French. What's the point of holding that piece of crap? It doesn't go anywhere. No value comes to it. That's why. So this is why when I saw Hyperliquid doing that, especially these volumes, I believe it's going to be something like so critical for our space, essentially, right? If you think about it. So we need projects like that are going to help us do that, okay? So now there's a reason why you need revenues and everything piping back to your protocol and token. If we think about like pumpfun, that's pumping a lot of revenue back towards a token. Why isn't that actually rising the way we think about it? Well, let's think about the type of market that's in, right? So we think about the revenue just piping back to the token. It also has to be dependent upon the market that it's in. But also, if you look at a project that isn't a pump fund, that isn't a Hyperliquid, that just has these tokens floating around, why do they exist? Why not have it? For example, why didn't the developer of the token or the issuer of the token and the team think to put that revenue back towards the token? Right? Because if you think about it, that's actually a loss of value for them. That's money going out. Instead, a lot of the teams, what they'll think about is how to sell the token. They'll think about how to arrive at the highest fully valuation, so they can list as high as possible to dump on everyone else. And that's what they do, right? So when you think about that, they're not thinking about revenue back to token. They're thinking about how the insiders can dump as effectively as possible. How all the revenues that pipe back, how they can take as much of that as possible. And I'm telling you right now, it's not a matter of figuring out how to build real businesses. Now our space is having that because we have real entities coming in, real companies coming in that are doing real things with real value. But before that, it was all fake. It was all designed to get people to believe that this is going to create real revenue. That developers are actually building a real product. It was fancy branding slapped on top of all this stuff that was creating no value. And how do I know that? Because if it was real value, people would have bought the token and the token would have had a value to it. Hyperliquid, people are buying it because they believe it has a value to it. The other stuff is going down because it's crap. There's no value to that stuff. That's why it's going down, right? So when you really think about what's happening in the market, this is why it's so critical. Now, I want to talk about something I've been speaking about for many years, and that's the starting fully diluted valuation. Now, what did I say? I said, hey, if you start off at a more reasonable fully diluted valuation, which is lower, you have a higher probability to go up, right? So what you would find, though, is teams wouldn't do that because it's a risk, right? Because it actually takes skill to go up in price. It doesn't take any skill to go onto a spreadsheet and say, you know what, we're $300 million now instead of $200 million. You know, that's what we're going to be, $300 million FTV, and to program the price. That does not take any skill. Okay, let me give you an example of that. When I started my project, a lot of people don't know this, but I built my whole project from end to end, grew it to hundreds of millions in market cap. We have $30 million in liquidity pool. We had 75,000 individual holders. Community was thousands and thousands of people, tens of thousands of people in the community. That's what I built. Now, when you start thinking about this, that market cap started at a $550,000 fully diluted valuation. Very, very low. The community could get into that. Everyone got in at a great price. Even private got in at the same price as the public, but private could buy a little bit more tokens, still to a cap max, so nobody got really excessive amount. Very fair distribution. Now, when I launched that, why did the price go from nothing to $200 million in 3 weeks? Well, that was hype in the market, but the other piece of that is it had the probability to do that because of how it was designed. Because when the liquidity came in, it propped the price up, instead of us trying to think about how to start up at 200 million and to drain all off through token sales. And that's what these teams are doing, right? They're saying, hey, we're going to launch at $1 billion valuation with no revenues and no real justification of that price. And we're only doing that because our investors will get pissed off if we go less than that. We're only doing that because that lets us extract the most from the market. Our market makers tell us we can do that. And you can look at a beautiful chart as Story Protocol as a great example of mass extraction. Even after the founders, the CEO said he's leaving, the price went up. That's all thin liquidity, price manipulation, garbage trash that's extracting from retail, and it poisons the entire market, and it creates a negative sentiment in the minds of people buying into that crap. And so that's what we're trying to do here as an industry, is create situations where people can get into real opportunities. And that's what we're trying to do, right? Now, if we think about where the real return actually comes from, at a normal venture company, where are they going to get their returns from? Well, if we think about this, in the venture capital world, they get customers, they create revenues, they create enterprise value, then eventually it becomes publicly listed maybe, or they get acquired, and then they get a massive return for that. That's what they're banking on when they do that. In a Web3 venture, let's just think about this. They don't have to do any of that work. A Web3 venture can say, for example, let's just fund this. Let's slap on a bunch of fancy branding. Let's do the product. We have a great team that's ex-Google and Microsoft and Apple and all this. That'll make people excited. That'll let us list at a higher price. Let's just do that. Now we end up here, and literally the price is a function of all the insiders and what they determine on what they can sell. The price is not a function of actual value, like it is in the traditional enterprise, in the traditional equities world, right? Where we have an actual business that has created value for customers that is then sold, whether it's, in traditional markets, right? Equities or whatever, through stocks, right? They do an IPO, they publicly list. Now they're able to exit. The team can exit through real public buyers buying the stock as that opportunity. That's how things should work. In our space, we short circuit that. We don't have to create any real value, but we can still dump on the market. But the problem is the people buying that are not buying a real business or buying a token, which will probably go to zero. And why will it go to zero? Because it's often attached to nothing of real value, has no real revenue piped to it or buybacks or any kind of real value. And now we wonder why it'll be zero, because it will. Because by definition, it should be zero because it has no value to it. So nobody's using it. No value is going back to it. Why would we expect the price ever to go up? Why would we? The only asset that can do that is Bitcoin, right? Because it has the demand people and it has a massive market attached to it, right? So not all these tokens are Bitcoin. None of them are actually. Now, we start thinking about the four ways out for one buyer, right? So let's think about this. So in our market, buyers can easily get trapped, if we think about this. So if we think about buyers that can actually get trapped in our market, this happens. Okay, so buyers that get trapped in our market, they buy these tokens, they can't get out of them. So a great example would be Pripco. If we think about a real world asset, okay, I go on Pripco, I can buy a tokenized property, that's a rental property, and I get rental money. Okay, and Pripco handles the whole process for me. Now here's the thing. They open up 2 windows a year to sell your tokens, and if you don't sell them then, you can't get out. So you're stuck, all right? So think about the 4 ways out, one buyer. This is what we want to think about. Let's think about why in the context of a lot of these tokens, how people dump on us and how that happens, all right? They can sell listing. So you've seen all the insiders, right? Or all the airdrops that we give out, right? So we have this massive airdrop campaign, millions and millions of dollars. Well, where's that come from? Who funds the millions of dollars that people sell and make that money? That's exit liquidity from retail buying the token. That's who funds that. Or maybe we could sell it across the vesting schedule, right? So let's say, for example, we have, $100,000 in buybacks a month, but we emit $1 million of tokens. So we're negative 10 to 1. Stupid. Right? So we want to look at the whole vesting schedule, how our whole economy works together. We want to sell the locked position on OTC, right? We can sell that. Now, here's what you see. I'll tell you right now what's happening. So literally, you'll have a team that you've bought into as retail, and you own the tokens at list price. They're taking the tokens they have that they can't sell in the market openly themselves, and they're doing an OTC deal off their treasury. They take some of the treasury tokens, they discount that by 30%, then they sell that to somebody. They take all the money. They don't sell on the market, they sell it OTC. Now, those companies that buy that, they might have a very short lockup of a few months. And so they're banking on the price maybe staying around that amount. When it unlocks, they dump it and sell, and they take a 30% profit. The team got the money right away, didn't have to sell in the market. People who bought the tokens have that. And these are all the companies dumping on top of you if you're dumb enough to buy in a lot of these shit coins that are on the market. That's literally what's happening. You got the unethical team sitting there with tokens. They already raised money that they blew on probably parties and everything else in Dubai that actually drove nothing for customers and real value in their business. And now they need money, so they sell tokens. That's all taking from the market. No wonder why we keep going down. So also we have short perps against it. Let's just think about this. You go and you spend all this money to list on a major exchange like Binance, and they put all the short positions against you. Literally, to get people inventory to sell the token on top of your head, hoping that it'll go back down. That's what they do, right? And usually, that's going to be a pretty damn good bet in a lot of these cases, especially in the Binance Alpha. You go on there and those are going to be going down. Why? Because we've done the math on that. About 95% of them went down. So if you just short every single listing, you have a really high chance of making money, right? So that's what they bet on. So anyway, that's some of the stuff that happens right now. And that's what's going on in the market. That's the stuff that needs to stop if we're going to get retail into an actual environment where they can buy something of value and feel protected outside of the world that we deal with here in our crypto world. Let's think about other exchanges. The whole investor is protected very closely in a lot of cases, especially here in the U.S. I speak a lot from my own frame here in the U.S. This is what we have. A lot of regulations here. Sure, other countries rather aren't the same. Let's think about the consequence of routing revenue to the token. It's a threat to the actual number, right? So the moment real cash reaches the token, the market can put a multiple on it. Right? This is also a risk, okay? Let's think about this. Your tokens, let's think about Story Protocol as an example. I love this one. Story Protocol raised $200 million. They were making about $15 a day in revenue of the protocol. What? You can, I did a video, I'll fire up a lawnmower, I'll make more money per revenue than you, right? So you think about this, the moment we attach a revenue figure to a token, we let somebody do some math and figure out the value. Before that point, it's all speculative. Trust us, we're getting revenue. You don't know how much this token is worth. People, XRP is bullish. You have no idea how much will be tokenized in the future. Everything will be on XRP. It'll be trillions in transactions. No, it's not, because XRP only captures a small fraction of the transaction cost in this. It doesn't capture that value. It only captures a small transaction cost of the value. So it's not going to be trillions, might pipe through that. It captures a fraction of that. That's a shit business model. If you're managing trillions and you only capture a small bit of that, that sucks. So we keep going back to this. The protocol will earn the fees, and then the market prices it based on those fees, right? The same thing with protocol with kind of path B here. So in the very beginning, we think about this, how S&P and other, entities and other firms, basically, as we look at this, we'll be able to put value on these tokens, decide, hey, should this be kind of listed? What factors do we look at? They're going to start to put these criteria in place, and they already have. And so that's why only like a small fraction will pass criteria, is because they're not actually doing anything of value, right? So if we think about this, that's why it's ultimately very important to make sure that we have the right protocols and everything in place that are actually creating value in our space. So if you look at path B, protocol earns fees. It keeps the token abstract. We have governance, ecosystem points, no multiple to compute, right? So when you start thinking about revenues, you really got to start thinking about, in that state, you're actually putting a value that someone can calculate. That also is important to make sure you have revenues. And that's why I laugh about Story Protocol, is the moment you can track revenues against the value, it's laughable. And that's not a real investment that people will want to get into. Right, so start thinking about the differences between these two different projects and things like this. Start comparing So let me just give you an example of a company that raised tons of money and went out of business. Movement Labs raised $140 million and filed for bankruptcy, went out of business. Now, if you start thinking about our space and yacht parties and Dubai and blowing money and all this, a lot of times these things don't create any value for customers. And so when you start thinking about the companies that are coming into our space that were raising money and what they were raising the money for and how they were spending the money, it's unrealistic in any form of business I've actually operated in for 25 years. So I'm 44. I've been operating various forms of industries and businesses since I was literally 12 years old, if I go way back when I got my first job. 18, I got my first real job, right, essentially, where I work on my own. But from that, I have a lot of years of experience. I'm 44. That's a lot of years. When I put that together, and I paid a lot of attention all those years, none of those businesses that I worked in would spend money like that, as wastefully as our industry has. And you start thinking about it, why are you out of business if you raise all that money and you have the most efficient products that you can create on smart contracts and you enable all this efficiencies, you get rid of all the waste and processes, you have all this structure, you can scale almost infinitely. Hyperliquid has only less than 15 employees. They're creating millions and millions of revenue. Why does your company, and they funded all themselves, by the way, the owners did, co-founders rather. So why does yours need to raise $140 million and go bankrupt, whereas another one create value for investors and buyers and everything of the token in a different way? That's because you waste it, because you're not spending it the right way. You're not thinking about investing that in the probability that will increase the chance of success to get revenues, increase the chance of success of making it succeed outside of hype and yacht parties and garbage like that. It might make the CEO and all the team seem like rock stars. Now you're out of business. Now you're bankrupt. Look great, don't you? So you start thinking about how you manage the finances of the treasury and everything else. This is also what I pay a lot of attention to. And you start thinking about publicly listed companies that would spend money like this, they'd be sued. Some of the things that in our space people spend money on, they would be sued for doing that, as reckless as they are with the funds. So let me just share one thing here as we keep going through our videos. So we have Hyperliquid here. We compare that to pumpfun. Now, if we're going to compare these two entities, one of them has a lot more revenues than the other. Now, when I personally start thinking about why one has, the token price what it is, and the other one has its price what it is, its market cap versus what the other one is. Now, you're going to find that this is the future state, right? We start thinking about these gambling, these kind of shit coins and stuff. Why do people want to get into those? It's for attention. It's part of the casino, but we got prediction markets for that. That's keeping people plenty busy. They don't want to gamble on these coins that were actually robbing the market. Now, if we think about this, most people that bought tokens on pumpfun lost money. That's what happens because they're all crap, shit coins that are all pump and dumps. None of them are meant to last. None of them. It's really called pump.fun. It's not meant to launch anything serious. So Hyperliquid has a whole different brand, a whole different frame to it. Okay, so we start looking at the market caps, the buybacks, and the investor sentiment, and start thinking about the professionalism, the market the team's going after, how big that can be. How massive all the assets coming on this, how that will enable new markets that are not possible today. How Hyperliquid will enable that. How when stablecoins are in the market right now, now you've got assets able to transfer, interact with each other a lot easier on Hyperliquid, especially as they connect with all these different protocols. Now they have their own chain as well. They don't have to be stuck in kind of product development roadmaps with Ethereum and their speed of smell development. So you start thinking about the advantages certain projects will have in the market and how they capitalize on that. That's what we're seeing here. You can have the exact, almost the exact same buybacks flowing back to the token and still do nothing. Because what I look at this through is actually the platform, the brand, where we're going, the market where we're going. Pumpfun, to me, is a piece of crap that I hope dies out. That's what I'll say here. It's literally a piece of crap. It's a crap stain on our industry that makes people gamble into things that are getting scammed in most cases. And that's what it is. So we need to think about what we're bringing to our industry and how we're helping people get into our industry in their first experiences as well. Now, here's the thing. Let's think about this. Nobody dumps a price they think is fair. So if I'm working and buying these tokens and stuff, then I'm like, hey, you know what? This seems fair to me. I'm going to hold on to that. I have tokens I'm holding right now that seem fair to me, that I believe will go up later. And I'm holding those for that reason. I have confidence in them, right? So if we think about pricing it honestly, that will help more people want to get into it. I talked before about, hey, in many years, what if we have a high FDV? A high FDV, what does that tell people? Greed. Greed. We're not believing this. We don't believe it can go up. So we're going to launch it at a high price because we don't believe it has a chance to go up later. So we're going to short circuit that and not take the chances as a team. We're going to launch here. And that way we can take all the money. That's what people are doing. Okay? How about the insider slice? How much do the insiders have? That tells me right away how aligned the team is. With my own project, almost the entire supply was able to be bought by the community or inside the liquidity pool when we launched. Hardly any of it was held by the team. And that communicated to the people instantly that we're aligned with you, that we're not looking to just dump. There are no massive team allocations. You know what? We started at a low market cap, so we had no massive plans for huge extraction and greed. It just so happened to explode to the high market cap that it was due to growth and due to people getting interested in this. And still we didn't dump on people and sell. We have $30 million of B&B inside the liquidity pool that we didn't dump on people and sell. So when you start thinking about how you build in this space and how people should be building this space and how they actually show their ethics through their efforts, this is what I believe people will start paying attention to. That shows also through the vesting. If I see all the insiders getting all the tokens right away, for example, if I see no lockup for investors and they get all their tokens in 6 months, what does that tell you? None of the investors believe in this damn protocol either. They want their tokens. They're out. They're out right away. They don't believe in this. If they did, why would they need to be out right away? Why don't you be patient? Why don't you let the market do its thing? Why, if you believe it go up later, why don't you want to be in right away at the lowest price? And that's the thing, is people don't want to take the risk. They want to take the absolute thing. They list the price high FTV, then they extract. And all the firms designing the tokenomics like that are also unethical, doing things like this and guiding the clients through that direction as well. You can also gate the treasury, right? So you really look at the treasury. What's that holding? How are they using the treasury? I'll tell you one thing right now. What I look at for a lot of projects, I'll look at the treasury wallet and I'll see if it actually has any money. Okay, so if I see the treasury running out of money or just sending it everywhere, I'm out of there. I know that thing's going down. That's sinking like a rock. I'm not buying those tokens. Even the team is sending the money out. Why would I be buying? Often they're selling. So this is what we're talking about, is how you look at how the team shows their hearts on their sleeves of what their actual mentality and thought processes are. And you can get a lot of that extracted just by paying attention to what people are doing. So if you take nothing else away from the video and everything I've put out so far, there's a lot of things to pay attention to when it comes to revenues. But more importantly, the main thing you can pay attention to is every single thing the team is doing. You can put it through a lens of, hey, is that for themselves or is that for the community and the people? And you can sense and feel that when you're looking at it. You don't trust what people say. You look at what they put out there. So someone might tell me, oh, we're all for the community. Then I might say, well, if that's the case, why does the community only have 5% for the public? How come you have investors that have literally 20% of the supply internally that are unlocking in a year, and the community gets 5% of that, and all these people bought it much cheaper? So are you for the community or are you for the insiders? So as I look at it through what you've communicated to me you're for the insiders because they have 4 times more tokens than the public. So can you communicate to me how you are for the community and not for the insiders due to your actions and how you've structured the token? Can you show me how you've done that? And when you start asking these questions, people, it's bullshit what they say. When you start looking at things like this, you can objectively understand and identify whether it's actually something of real value or whether they're just trying to sell you a story and get you to buy in to use you as exit liquidity. And that's the kind of stuff that we need to pay attention in the market. So hopefully you enjoyed this video. Hope you're having an amazing rest of your day.